Over the past 2 years, as the Federal Reserve fought to rescue the economy from the clutches of the coronavirus, the central bank's emergency remedies increased the nation's money supply by an astonishing 40%. Hi, I'm Jim Rickards. Today is April 12, 2022. We're going to cover inflation, coming recession, and rising interest rates. This article, which I just read from, was posted in the Washington Post. I will include a link to the article as well as links to the other slides that I show for your reference. We are in a period of time of crazy inflation. We know that. We all experience it in the various ways that we buy things and where we shop. I'll show you a chart showing the kinds of increases that we're experiencing on core items throughout the economy. This slide is about housing. And so the inflation is affecting a lot of things. This shows that the housing market it's a macro slide going back to 1994. So you can see during this period of time where we went from an undersupply to an oversupply when prices got cheap. And then today we're back to another undersupply where prices are escalating. So you can see it's a long macro view spanning 28 years. So that's the way these macro cycles work, housing being part of that. Each time we're in this period, I don't know how you think, but how I think is during this period of time where there is an excess of houses, prices are cheaper, we think, what's it going to take to come out of this? And then something happens and the direction changes. And here we are today. We're in a period of time where there is a very tight supply, prices are crazy high, and we think, what is going to happen that's going to get it back to a time when there are for sale signs everywhere and you can negotiate the price and things like that? That will happen. But forces will come into the market that will cause cycles to occur. There's always cycles in the housing market, job market, stock market, bond market, etc. Sometimes those are short-term cycles and sometimes they're long-term cycles or both. This is a chart showing again, it's a macro chart going back to 1993, so about 30 years, and showing the increase in the amount of apartments that were being built because there was demand, and then shrinking demand, and now increasing demand and construction of new apartment units. When we search for something, Google tracks all of the people who search, and they can identify and they publish what's trending today. Where are the trends in searches? So you can see in the term, the two words, housing bubble. You can see the amount of searches that have gone on for about 5 years, and then look at what happened recently. I don't know what caused it. Could be interest rates, could be just information in the press talking about the fact that we're in a bubble, which means it's going to burst. So people are concerned based on search engine results. This is a chart or set of data, and it shows the inflation rate on core items in 4 different components in our society. And the middle column, the gray colored column, is the last 15 months of price increases, inflation, that has affected these items. The last column is the last 3 months. The last column, even though they're lesser, percentage-wise are even greater. But I want to read you these, and I want you to think about them because these are affecting everything in our economy. West Texas crude oil, 98% increase. Natural gas, 137% increase. Gasoline, 116%. Coal, 255%. Think about this, 15 months. Metals, copper, 34% increase. Steel, 21% increase. And the winner is lithium, 967% increase. Agriculture, wheat, 62% increase. Oats, 108% increase. Corn, 56% increase. And in the industrial area, cobalt, 154% increase. Aluminum, 73%. And nickel, 102% increase. I looked at these and I thought, just wanted to get a sense for the average. There are 13 items here. The average of the 13 items is 247%. Then I thought, well, lithium is kind of way out there. So I'll just take lithium out. That left me with 12 items, and the average of those 12 is 187% increase in 15 months. Nothing new, but it's sobering to see this. So when people end up with less money in their checking account, it's like, where did all that money go? And they're maybe draining off of savings and because they have to, or they're borrowing money on credit cards because they have to. This is what's causing it. I want to show you a slide, or show you a clip that is from thehill.com. It shows the inflation on fuel, impact of fuel, and the impact on groceries. So take a look.
U.S. corporate profits hit a record high in the fourth quarter of 2021, even as GDP lowered. So what does this mean exactly? Well, it means inflation is good for big businesses, which upped their prices in response to supply and labor shortages and saw profit margins increase 25% to $2.94 trillion, the largest gain since 1976. And while we know gas prices are taking a toll on working people, 25 of the world's biggest fossil fuel corporations are reaping in record profits as well. Oil giant BP, for example, has hit its highest profits in 8 years.
The USDA predicted the cost of gas will continue to rise this year, and food as well. You can expect to spend another 4% on groceries by the end of this year, including meat, poultry, dairy, vegetables, and more. But despite this news, MSNBC is still confused as to why Americans are dissatisfied with this booming economy, in quotes.
So this slide is the Fed officials plan to shrink the balance sheet by $95 billion a month. What's that about? For many years, the Federal Reserve has been they've been a buyer of U.S. Treasuries and mortgage-backed securities. They were buying about $80 billion a month in Treasuries and about $40 billion a month in mortgage-backed securities. Now they are selling. They're turning around and reversing their action and selling the same thing, Treasuries and mortgage-backed securities. They're selling about $60 billion a month in Treasuries and $35 billion a month in mortgage-backed securities. So what that's doing is flooding the market, and then they are, at the same time, raising interest rates. So the market has got a headwind on it. So if you notice that Treasuries, bonds in portfolios, or if you pay attention to bond rates, you will clearly see that bonds themselves, bond funds, are sinking. And this is not just government bonds, it's the same is true for high quality corporate bonds as well as low quality corporate bonds. All of them are sinking, and they have been sinking for some time, putting traditional methods of investing, traditional investment portfolios, traditional and financial advisors in a lot of trouble. Those have they've accumulated some pretty big losses. And this is one of the issues behind it. This came off the Federal Reserve website, and it shows the amount of liquidity that is in the Federal Reserve or lack of liquidity. And when you go back to look at what was on the balance sheet in 2008, they had about $800 billion in assets in the Federal Reserve on their balance sheet. Then along came 2008. They did quantitative easing 1, 2, and 3. So in other words, they flooded the market with liquidity, dollars, and which means they put that on their balance sheet. So then we went from 800 billion to 4.3 trillion. That's an increase in a few years of 500%. That stayed there, and if you look about the middle of the chart, you'll see it started to dip. And what they were doing was trimming their balance sheet and pulling some money back out of the liquidity, back out of the economy. Then coronavirus hit, and you see the very far right of the chart, then all of a sudden they flood the market again with money, liquidity, trying to prop up the economy. And of course, it propped up the stock market as well. That money had to go somewhere. So you can see at the far right of the chart, the acceleration in money supply. Money that went into the system, came out of the Federal Reserve. And so now they have about 9 trillion on their balance sheet. And all of this, I call it funny money. All it is just paper. There's nothing behind it. They did not buy, that I can find, 1 ounce of gold. Nothing is backing that. All it is pure paper. And it's only worth what you and someone else can agree that it's worth. It has no intrinsic value, and nothing behind it has intrinsic value. We've heard the term, hopefully you've heard the term, inverted yield curve. Inverted yield curve, and I'll just cover it briefly, I covered it last week. What it means is that you have typically a spread in yield dividends between the 10-year bond and the 2-year bond. The 10-year bond pays a higher yield because you're taking more risk, you're holding it for a longer period, and of course the 20-year bond, even longer and greater yield. What happens when people worry about holding something that long, there's uncertainty about the economy showing in the yields that people will accept. What happens is that the 10-year yield drops to the level equal to, or in some cases even less than, the 2-year yield. So you're getting a premium for the short-term bond, when in fact, in normal market conditions, normal economic conditions, you would get a premium for the 10-year. So they kind of cross and they go in the direction they probably should not go, and that's why it's called an inverted yield curve or inverted rates of the 10-year and the 2-year. What's significant about this is that back to 1970, so if we go back 50 plus years, this has happened 7 times. It just happened about a week and a half ago, the 8th time since 1970. In all 7 of the previous times, 100% of the time, that was followed by a recession. So it has become known as the primary indicator for a recession. It just happened. So economists are now thinking that we are headed into a recession. The good news is that historically there is a lag between the day that hits, which was about 12 days ago, the day that hits and the beginning of an official recession, 6 months to 24 months out, the beginning of a recession. Now, what I want to say is that doesn't mean that the bond market and the stock market have their correction starting at that time. Typically, they will move much faster than the market, so I'm not saying it's going to be tomorrow or next month, but I'm saying if it is 6 months at a minimum, usually the stock market and the bond market will be affected prior to that. The bond market has already been collapsing, so that's nothing new. So we don't know exact timing, other than to say economically that if the last 50 years are an indicator, we are going into a recession, and it is in our future, and it's in our not too distant future. This not only affects the stock market and bond market, but it also affects the job market. Typically, when you look back at these deep recessions that have happened the last 7 times, there are tens of millions of people who lose their jobs. Home prices plummet. So when you worry, you think about with real estate, is real estate going to become more available, maybe more affordable? If it follows history, that is what will happen, because there are fewer people with less money, because stock market, bond market, job market, all of those have shrunk. Believe me, it affects the real estate market. So if you think, what will it take? Something like that is what it will take. If you look at the very far right of the chart, I'm going to blow that up, and you can see that very right piece of how the market went down during that period of time, and that's what this slide is right here. So you can see, this just goes back for a month or so, and you can see as this is the relationship of the 10-year versus the 2-year, the difference between the two. So that difference began to collapse. The 10-year began to go below, for a short period of time, below that zero line, and became cheaper than the yield on it became less than the 2-year bond. So that's the indicator, and it doesn't have to go down far. Sometimes they go on down further, but it just needs to cross that line where it actually indicates that people are willing to, they are unwilling to tie their money up for a long period of time in bonds. This shows this period of time. This shows 7, counting the current one. The current one is at the far right. If you back it up, this goes to 1975. If you back it up to 1970, which the chart does not show, you would see the 8th one, and then the severe 73-74 recession that followed. So it doesn't quite show that. But if you include that one, then there have been 7, and this would be the 8th. This is how they work. You can see where I put the arrows. You can see where it crossed below that line, sometimes just briefly. And the gray lines, the vertical gray lines, are the recessions that followed. Sometimes they're very deep. I've been saying, I think the 73-74 crash, it was very similar to the conditions that we're facing now. There was high interest rates and increasing interest rates, increasing inflation, high energy prices, remember lines at the gas pump, and a crashing stock market, bond market, and job market, and housing market. All of those were characteristics of the 73-74 collapse, and the stock market went down about 50% at that time. So I think personally, this is an opinion, I think we're headed for something like that. I think the stock market will have a severe correction. I think the bond market has already started cratering. Because interest rates, I think, are going up. They have to do it because they have to fight inflation, and their number one tool is raising interest rates. So that means that bond rates have to come down. It'll be both corporate bonds as well as government bonds. So that is the scenario. If you want to study something, study the 73-74 crash, because I think that's the one that looks more like today than the others. Now we've talked about the 2-year and the 10-year government bond. So this is just the 2-year, but you can see the degree to which people are putting their money into the short-term treasuries, 2-year treasuries, more so than the others. So this line has almost gone straight up in the last 8 months, since last July or August. And it gone straight up. And it is now, the short-term rate has gone from about 20 basis points to 257 basis points. That's an increase. And conversely, the bond price is collapsing. The bond price goes fund goes in the opposite direction of the yield. This is the 10-year. You can see is not as much money was going into that as was going into the 2-year bond, but it too has climbed. People are asked when they think a recession is coming. So this is a survey. So most of the people think that the recession will be next year, 2023. We don't know. Could be this year, could be the year following. But if it is 2023, that does match with the time period based on the difference between when the yield goes negative, the spread goes negative, that 6 to 24 month period would squarely fall in 2023. I saw this last week, and I saw it from multiple news sources. So every news source I could find had the same article, so they must have put out some kind of a release on it. Bank of America warns recession shock lies ahead. A recession shock. Wow. So in other words, we're going to be shocked at how severe it comes and how hard it's going to be. I believe it's going to be deep and it will be prolonged. And this will decimate most portfolios, and it will decimate most financial advisors because they have not constructed portfolios around getting out of the portfolio or changing to defensive assets when that time comes. They believe in just riding it all the way down, and eventually you ride it back up. And I don't believe that, so we do tactical management where we get out of the way or go to defensive assets. And I'm just completely unwilling to ride the market down. So far we've been successful, but we have not really been tested with this. I don't look forward to it, but I'm prepared for it. And so if the market goes down severely, our tactical model will kick in and we will be either out of the market or we will be in defensive assets. Okay, I want to show you these are major indexes, and I highlighted in yellow the best and the worst. So this goes back for the last week, the last month, the last quarter, which is approximately year to date. So you can see the best has been the Dow. The Dow is a value-oriented index, and it has lost 1% of its value the last week, 0.5% the last month, and year to date, almost 5%. That's the best. AGG is the benchmark for the bonds and the aggregate bond index. The last week, 2.26%. Where was the protection when it was needed? The last month, 0.3%. The last quarter, 7%, and the year-to-date, 8.5%. No protection. It's gone. It's gone because yields are going up and interest rates are going up. S&P 500 next. Lost 3% in the last week, almost 7% year-to-date. NASDAQ 100 lost 7%. Last week, 7%. For the month, 2%, and year to date, almost 14%. And the worst is the technology sector of the NASDAQ 100, Last week lost almost 10%, for the month 2%, and year to date about 20%. So you see, from the best to the worst, that's a context for the market, both the bonds as well as the stocks. Most people have lost around 10%. Some have been in the teens, but I think 10% or so is common because of some mixture of these. Now I'm going to show you what we publish, our fact sheets. We publish those and update them from live tracking accounts. And so we show two of them. One is our moderate strategy, and the other is our high performance. And our high performance includes leverage, which we don't recommend for most investors, but we track it. The moderate portfolio, since the beginning of the year, has lost 3%. Remember what I just showed you. And for the last 12 months is up 10%, and since inception is up 17%. The high performance portfolio has lost 2.96%. The 12-month rate of return is 26.97, and the annualized rate of return since inception is 33%. Now, I don't like to lose money. I don't like to lose my clients' money. So whatever I can do to avoid this, I will do it. But I don't do it on hunches. I don't do it on feelings. I do it based on a sound, mathematical, proven, tested methodology. And so we were able to avoid, to get out of the way of a lot of the risk, but we did not avoid it. We learned from it, and I think we've made some improvements so that next time we will do even better. But we still have losses. The question I ask for investors is, what kind of loss are you willing to accept? Think about it, because you know you're going to have losses from time to time. So I ask myself that question too. What kind of loss am I willing to accept? Are you willing to accept a shallow loss for a short duration? Or are you willing to accept a deep loss for a prolonged duration? Which one? Well, the answer is clear. I know which one you would choose. But my other question is probably more important. Does your portfolio or your methodology follow what you're saying you want? If you want a shallow and a short duration methodology, does your investing methodology or the investing methodology of an advisor, does that track with what your desire is? Or are you in portfolios that are set to experience that deep loss for a prolonged duration? We haven't seen that for a while, but I believe we are going to see it. And I think the stage is set because assets are so incredibly high. Job market is tight. The housing prices are ridiculous. The stock market is still, even though it's pulled back some, is still crazy high by historical standards. And the bond market has been crazy high, and it's already started to come down. All of these are signs that we are in for, in my opinion, a very deep and prolonged recession, and it will show up in these markets. When I look at these are stock market indicators. It's a dashboard that I put together. So you can see 6 different indexes. The 4 from the US, the Dow, the S&P, the NASDAQ 100, and the Russell 2000, and 2 from foreign markets, the developed markets, and the emerging markets. EFA and EEM are the ETFs. And then to the right, the four columns to the right are the moving averages. Where is this ETF in relation to its 20, 50, 100, and 200-day moving averages? 2 of them, the Dow and the S&P, are the only ones that are above their 50-day moving average. Every other scenario they are below, which means they are probably moving down in a directional way. So this is not a good chart for investors. So last week, over on the right side, there are 24 dots. And last week there were 14 out of the 24 that were green. Today, there are 2 out of 24 that are green. So it is, the market is showing that it is weak, and this is not a good sign. When you take the market, take the S&P 500, and you break it apart, you find that there are sectors inside of there. There are sectors in our economy. So these, for example, this would be the energy sector, real estate, materials, consumer staples, healthcare, telecommunication, retail, technology, etc. These are the various sectors. So when you break the sectors down and look at what's going on inside of the S&P 500, the component parts, these are the 11 component parts, tells a very mixed story. So you see the top 5, energy, real estate, materials, consumer staples, and healthcare, are all above their 20, 50, 100, 200-day moving averages. The rest of them, except telecommunication hit one of them, but the rest of them are all below their moving averages. So what it tells you is there is not market breadth. It is a mixed market. Some sectors are doing well, some sectors are doing poorly. That is just interesting. The market is split. And last week there were 28 green dots. This week there are 21. Okay, this is a chart of the S&P 500 with the tracking stock ETF SPY, and it is a 52-week period, 1 year, and each move represents 1 week, so it's called a weekly chart. And I put a 20-period moving average on there. So you can see how the S&P 500 has done relative to the 20-period moving average. Up until the end of the year, in December, the S&P 500 was in an upward trajectory above its moving average. And then in December, or January for sure, then it began a downward direction. It tried to go up, and now it's collapsing back down again. So I put the black arrow on here just to show you that since December, while there have been up and down periods, the general direction is down since December, but the longer term is still in a somewhat upward trajectory. This measures, again, inside the S&P 500, and the economy, there are growth stocks and there are value stocks. Growth stocks are oriented to growing sales, and value stocks are oriented to growing profits. Usually they both want both, but they tend to emphasize one or the other. So you can see when you put the index, the growth index, you can see, much like what I just showed you, that for a period of time up to November, the growth in a relationship, this is a relative performance, the relationship of the growth index was positive relative to the value index. So it favored growth. Since that time, when it goes down, that's going to favor value because the numerator is growth, denominator is value. So when it goes down, value is in favor. You can see, value is in favor. So growth is out of favor since that time. And this takes the small cap, the IWM, the Russell 2000, that puts on a 12-month chart, weekly chart, and you can see the general direction of the small cap relative to the S&P 500. Whether they are going up or whether they are going down, in general, the S&P 500 is stronger than the small cap. Said another way, the small cap index, IWM, is weaker than the broad market, the S&P 500. I expand the 12 months and I go out to a 24-month period to show this because I think it works a little better. This is the bond. This is the long-term government bond, the 20-year plus bond that represented by the ETF TLT. And you can see 2 periods of time, and this is not relative to anything else. This is just TLT. You can see for a period of time where TLT dropped significantly, just dropped and dropped and dropped. And then it went up a little bit, and now it's dropping again. That bottom right of the chart, it wants to go right through the bottom of the chart, and that does not include Monday, which was down. So it is going down and going down further and faster. And so that is not supposed to happen. That's why financial advisors, I think, I won't say they're going crazy, but I think they are really scratching their heads thinking, what is the answer to stock risk? They have been to school and told over and over and over again, you put bonds together with stocks. You know about this, you've heard this story. Put bonds together with stocks, and that's your answer to stock risk. However, the people who have taught them and the people who have taught them and the people who have taught them did not add one phrase to that. And that phrase is when interest rates are falling. Because when interest rates are falling, bond prices, generally speaking, are going up. But when interest rates rise, none of them have gone to school during this period. But when interest rates rise, which they were from 1946 to 1982, when interest rates rise, bond prices fall. And that's what we're seeing today, the repeat of that long macro cycle that began back in 1946. Okay, I'm going to show a picture of gold. This is direction of gold. So yeah, stocks have been down. Guess what? Not gold. Gold has been up. What about silver? Silver's up. 24-month chart. And continuing to rise. I'll show you that later. And then I show a chart showing the relationship. This is relative performance of silver versus gold. So silver being the numerator, gold being the denominator. So what that means is if the chart, the line is rising, that favors silver relative to each other. And the red arrow goes down, that favors gold. So gold has been doing, relatively speaking, better than silver, but they go back and forth. And they both, generally speaking, have gone up, as I showed you. Then I put in the volatility index, and this is, as of Friday, this shows that the black line kind of is an arbitrary line. I put it at about 25. When the index typically is above 25, that means it's moving up into a riskier area. The market is moving up into a riskier area. And when it's below 25, it is, less risky. So it's bounced up a little bit, and this is as of Friday. It does not include Monday. But the general direction is still down, meaning the risk has tended to come out of the market some relative to about a month ago. Asbury puts some charts up. I'll share these. These are the metrics that they use to measure components of the market. The last component is market breadth. What's interesting about this is that I showed you that chart with the sectors. Half of them were positive, half of them were negative. That's not market breadth. That's a separated market, a split market, and not moving in the same direction. And that's indicated by that pink box showing there is a lack of market breadth. This is a chart showing the flow of money into various ETFs, sectors, and so where this doesn't necessarily mean they're performing the best, it's showing where the money is going. And the money is going out of financials, I think function of interest rates, and it is going into healthcare. So those for the last week, the last month, and the last quarter. So those are kind of the consensus winners and losers. And then asset relative performance. This is interesting because it compares different types of assets to each other. Stocks and bonds are both going down. Stocks are going down less than bonds. So relatively speaking, they're the best of the worst. I guess that's the way you'd say it. And is low volatility or high volatility in favor? Of course, low volatility is in favor. It's a period of increased risk. Large cap or small cap? Large cap is definitely in favor because remember you saw that chart with the Russell 2000 going down relative to the S&P. Clearly, large cap is over small cap. And is the broad market, the S&P 500, doing better than the NASDAQ 100? Again, previous chart, no question about it. The S&P 500 is clearly favored over the NASDAQ. Growth or value? We showed that chart. Value is doing better. U.S. versus developed markets or developing markets. U.S. is doing better than both. Bonds, corporate and government bonds are both doing very poorly. And weekly, monthly, and quarterly. So the best of the worst, the one that's doing the least worst, is government. High yield or corporate, corporate quality, high yield meaning low quality versus high quality, low quality, high yield is doing better. So corporate bonds, high quality corporate bonds are doing horribly. Reminds me of a quote from Scott Minerd, the global chief investment strategist for Guggenheim Funds, and he is an expert on bonds, and he said, I think about a year ago on Twitter, he said that the look out for corporate bonds. It's a bond bubble, and that's going to break, and there is going to be defaults everywhere. I think he's used the term 40% are going to go into default. Here we are. Short-term versus long-term, short-term bonds, as I've said earlier, you could see that on the charts also, is doing better than long-term. Okay, U.S. versus the world. The U.S. is not favored in a predominant way in any comparison. Those that are doing the best are Australia, Switzerland, Malaysia, United Kingdom, and India. Those are dominant in all three categories. That doesn't mean they're all doing wonderfully. It just means relative to the U.S., they are starting to do better. So I thought I would take one. I did this last week. I take one. I chose Australia to show you that how they look, their market relative to the U.S. market, the S&P 500. So you can see at the end of the chart, this is kind of the end of January, that their market relative to ours has gone straight up. Why is that? Well, ours has gone down. So let's just say, for example, their market remained flat. Relatively speaking, that would be an increase. Or maybe it had a slight increase and ours went down. That would represent an increase as well. So that's an example of how Australia would be rated higher than the U.S. in the weekly, monthly, and quarterly. Gold, as of this morning, gold was up 2% over a week ago. Silver was up 4% over a week ago. When it looked like everything was going down, bonds, stocks, all kinds of things were going down, something else is usually going up. In this case, it's precious metals. So precious metals are going the other direction. But how many times have you heard, I certainly have heard, how many times have you heard financial advisors or Dave Ramsey or Susie Orman or somebody tell you that by financial advisors tell you that gold is a horrible investment. Well, it's not an investment. It's an insurance policy against declining value of the dollar. What are we seeing? We're seeing the declining value of the dollar. And why is gold and silver going up? It's not going to go straight up. It's going to go up and down. But it's holding its value when nothing else is holding its value. What about Bitcoin? I thought Bitcoin was the alternative currency. Bitcoin lost 9% of its value last week. 9%. I hate to use the word garbage, but it is backed by nothing. If you don't like the paper and paper money, why in the world would you want crypto with nothing behind it? It's about the same. It's about the same thing. The only thing that has value is what has intrinsic value. Gold and silver aren't the only things that have intrinsic value, but things that have intrinsic value do well during periods of decline, because then you get to see what things are really worth and how puffed up things are in our economy when some of the air comes out of the balloon. In 1912, toward the end of 1912, J.P. Morgan was asked to testify before Congress. It was kind of an antitrust hearing. He was looking to consolidate some banks and build alliances with other banks, both in the U.S. and in England. So Congress pulled him in and had a long question and answer session, an interview, if you will. And in that long interview, by the way, I'm going to attach a link to it below the video so you can see the script of the interview. It's an interesting interview. And they grilled him. They were grilling him on definitions and questions. What about this? What about this? It's what they do. And what they said, they wanted to define money. What is money? They're trying to nail it down to, is it a commodity or what is it? And getting at the heart of what his agenda might be. And finally, he said in the interview, I was reading it, he said, gold is money. Gold is money. Everything else is credit. Paper is credit. It's not money. You and I may use it to transact business, but it's not real money. Gold is money and silver is money. And you could go on and say platinum and palladium are money. Agreed. But I went back as I did more research into him. I saw that, and I knew this happened, but in 1895, the government had come through a panic. They called them panics back then. We call them a crash today, collapse, in 1893. And the government, they'd lost a lot of their gold reserves because people were redeeming their currency with gold. And so they wanted to hold about 100 million in gold. And I believe it was $100 million in gold. Of course, it was worth a lot more then. And that had been depleted down to about 40 million. And so it was really a treacherous time for the U.S. economy and the U.S. government. We were at a point where maybe the banking system and the country might collapse. And so he had gold, and he sold $65 million worth of gold. Think in terms of $1895. $65 million worth of gold to bail out the U.S. government. So this interview followed this period of time, and it also preceded by only a few months, preceded the formation of the Federal Reserve, and that's another story. But anyway, of course, he was running a bank and dealt in terms of currency and dollars and so forth, but at his core, he understood that gold is money. I've mentioned this before. Jim Rickards, a prolific author and speaker, he's written about 5 books. This one was formative in my understanding of what money is, and it's called The Death of Money. And it's published in 2014, and he goes into a lot of background on China, gold, and the International Monetary Fund, and maybe even some politics that relate to some of that. But it gave me a good understanding of money and of precious metals and how China plays into this, etc. A lot of it's just extremely relevant even today. So I put that up. You can also put his name in YouTube, and you will get a lot of interviews. He does a lot of interviews, and they're always current, they're always interesting. He's a very smart guy. I highly recommend the book. I thought of this. I saw this. I thought of, okay, when this trickles all the way down to the lemonade stand, maybe there's a message. Sorry, I don't accept dollars. Think about it. What happens if you go to the lemonade stand to buy lemonade and pull out your wallet, and the kid behind the lemonade stand says, sorry, I don't accept dollars. Well, what do you accept? Well, anything of value. That doesn't have any value. Thank you for watching. As I said, I'll put links to everything in the section below, or to as many as I have, and then I will appreciate your comments, questions. You can reach out to me at my number or my email address, or put comments below, and I'll respond to all of them. Thank you very much for watching.